Nobody is reporting on this properly. In late February 2026, at a financial industry forum most retail investors have never heard of, Citi's head of digital asset custody development used 4 words that should have broken through every financial headline on earth. 4 words that explain exactly why Bitcoin's bear market is irrelevant to the most powerful investors on the planet right now. She said, and I'm quoting directly, "Single service model, crypto, securities, and money, one account, one framework, one structure." That's not an experiment, that's permanence. One of the largest, most powerful, most systemically important financial institutions on planet Earth has been quietly, methodically, and with extraordinary precision building, not trading, not speculating, not buying dips, building, Citigroup, $257 trillion in assets under custody. A client base that includes sovereign wealth funds, central banks, pension funds managing trillions, and multinational corporations operating in over 160 countries. That's Citi, the one that processes more cross-border payments than almost any institution alive. The one with a balance sheet so deep it makes most national economies look modest. That bank, your bank's bank, has been quietly constructing what may be the most consequential piece of Bitcoin infrastructure ever assembled inside a traditional financial institution. And they're about to flip the switch. This is not a trading headline. This is not a price prediction. This is not a pump. This is plumbing. And once you understand what Citi is actually building and why they're building it right now, in this market, in this macro environment, you will never look at Bitcoin's price chart the same way again. So before we go any further, I need to ask you one question. And I'm not going to answer it yet. Is Wall Street buying Bitcoin or rebuilding it? Hold that thought. Lock it in. We are coming back to it at the end of this video. And when we do, the answer is going to reframe everything you thought you understood about where this market is heading. And if you're new here, this channel is called the Wealth Continuum. We don't chase prices. We map infrastructure. We follow institutions. If that's the kind of edge you're looking for, make sure you're subscribed before we get through the next 10 minutes. Because what I'm about to lay out is the framework that separates the people who profit from this shift from the ones who watch it happen in the rearview mirror. Let's build. Let me tell you what most people believe about banks and Bitcoin. They believe banks hate it. They believe Wall Street has spent the last decade lobbying against it, fighting it in Washington, dismissing it in earnings calls, and quietly praying it goes away. They believe the entire financial establishment sees Bitcoin as a threat to their monopoly on money movement. And they are not entirely wrong about the history. In 2017, Jamie Dimon called Bitcoin a fraud. In 2018, every major bank was either silent or hostile. For years, the dominant narrative was simple. Old money versus new money, suits versus code, TradFi versus DeFi. And retail investors built their entire identity around that narrative. Banks are the enemy of Bitcoin. Decentralization is the revolution. We're going to route around the legacy system. Compelling, emotionally satisfying, spread across every crypto Twitter thread, every Discord server, every Reddit post for the better part of a decade. But let me ask you something that I want you to genuinely sit with for a second. If banks truly hated Bitcoin, if the entire financial establishment was unified against it, why is 9 of the world's largest global banks forming a joint stablecoin consortium right now? Why is BlackRock managing $55 billion worth of Bitcoin in a single ETF product? Why is the US government holding Bitcoin as a strategic reserve asset? Does that sound like an industry that hates something? Or does it sound like an industry that spent a decade quietly figuring out how to own it? Stay with me, because the answer is more nuanced than either side of that debate will admit, and it's the nuance that actually makes you money. While retail was busy with the narrative, institutions were busy with something far more boring and far more powerful. They were building infrastructure. Think about what's happened just in the last 18 months. BlackRock launched a spot Bitcoin ETF, and it crossed 800,000 Bitcoin under management. That's roughly $55 billion in a single product from a single asset manager in just over a year. That didn't happen because BlackRock believed in the revolution. It happened because their institutional clients demanded regulated, insured, compliant exposure to Bitcoin, and BlackRock built the vehicle to give it to them. That's not ideology. That's capital allocation responding to client demand. And that was just the beginning. Custody frameworks are being built, digital asset divisions are being staffed, tokenization desks are going live, institutional wallet solutions are being integrated into the same systems that move trillions of dollars every day. JP Morgan is building deposit tokens on Ethereum. Bank of America is developing a stablecoin product. Goldman Sachs is expanding digital asset trading. Morgan Stanley is expanding crypto custody and trading. And 9 of the world's largest global banks, Goldman Sachs, Deutsche Bank, Bank of America, Banco Santander, BNP Paribas, Citigroup, MUFG, TD Bank, and UBS, announced a joint consortium to develop a G-7-backed stablecoin. A stablecoin market, by the way, that analysts project will facilitate $50 trillion in payments by 2030. $50 trillion. So let me reframe this clearly, because this is the most important sentence in the first 4 minutes of this video. This isn't about speculation. This is about settlement, custody, and collateral. These banks are not buying Bitcoin. And here's the question that most people never think to ask. Who controls the pipes? Because whoever controls the pipes controls the flow. And controlling the flow at the institutional level is a position of power that makes a trading desk look like pocket change. That's what we're going to break down in the next section. And I promise you, once you understand what custody actually means at the institutional level, Citi's move will look like something completely different to you. It will look less like a product launch and more like a land grab. Let me ask you something. When you hear the word a custody, what do you picture? A hardware wallet? A cold storage device in a drawer somewhere? A ledger with a 24-word seed phrase? That's retail custody. And it's fine for retail, but institutional custody is an entirely different animal. And understanding the difference is the single most important concept in this entire video. Because if you miss this, you'll misread every institutional Bitcoin headline you see for the rest of the year. Here's the reality. A pension fund managing $200 billion cannot self-custody Bitcoin. A sovereign wealth fund cannot hold private keys in a hardware wallet. An insurance company with fiduciary obligations to millions of policyholders cannot operate outside a regulated, auditable, insured custody framework. These institutions have compliance teams, regulatory mandates, board oversight, and legal obligations that make self-custody not just impractical, but illegal in most jurisdictions. So when people say institutions are getting into Bitcoin, there's a prerequisite that almost nobody talks about. They need somewhere to put it. Now think about that for a second. Because this is where it gets interesting in a way that most people completely miss. Bitcoin has existed for 17 years. Institutional interest has been building for at least 5. And yet, until recently, the qualified custodian infrastructure inside a major global bank didn't exist. Specialist firms like Anchorage and BitGo have been doing it. Coinbase Custody has been doing it, and they've done it well. But they're not Citi. They don't have Citi's $30 trillion in assets under management. They don't have Citi's sovereign client relationships. They don't have Citi's cross-border settlement infrastructure, its FX networks, its liquidity corridors into 160 countries. They don't have the trust relationships that Citi has spent 212 years building. Here's a question I want you to genuinely answer in the comments. Do you think the absence of bank-grade custody has been the primary reason pension funds and sovereign wealth funds have stayed out of Bitcoin? Or do you think it's been something else? Drop your answer below. I'm going to read through the responses after this video goes live, because this community has called institutional moves before the price reflected them, and I want to know where you stand right now. Here's the principle I want you to tattoo onto your brain. If you control custody, you control institutional adoption. Not the price, not the narrative, the custody. Because once custody exists at the bank level, truly integrated bank-grade custody, it unlocks every single downstream function that institutional capital requires. It unlocks ETF creation and redemption. It unlocks prime brokerage. It unlocks cross-margining, the ability to use Bitcoin as collateral against traditional asset positions. It unlocks repo markets, derivatives, and structured products. It unlocks allocation models at pension funds and endowments that cannot move without a qualified custodian in place. Custody is the door. Without the door, none of the rooms inside exist. And here's what I need you to stay with me on, because this is the detail that took me the longest to fully appreciate. It's not just that Citi is building a door, it's which clients are going to walk through it. Because Citi's client base is not retail investors. It's not hedge funds making directional trades. Its clients are sovereign wealth funds, central banks, pension systems with multi-generational mandates, multinational corporations that hold more cash than most nations. When those clients get a Bitcoin custody product at a bank they already trust, already report through, and already use for everything else on their balance sheet, the friction to allocating isn't just reduced. It's essentially eliminated. And Citi is about to install the most powerful door in traditional finance. But wait, before we get to the scale of what Citi is actually building, I need you to understand something about why this is happening right now, in this exact moment. Because the timing isn't an accident. And the institution didn't choose this moment randomly. The answer is hiding in a part of this story that almost no one in crypto is paying attention to. And if you stay with me through the next section, you'll have a framework that most institutional analysts don't even put together this clearly. So let me loop back to the question from the top. Is Wall Street buying Bitcoin or rebuilding it? We're getting closer. But first, the scale. Stay with me until the 10-minute mark. because what I'm about to cover in the next 3 minutes is something most financial media has buried in technical footnotes, and it contains the single data point that explains why Citi's move is categorically different from every other bank's Bitcoin announcement. If you check out before minute 10, you're going to miss the specific detail, the forward phrase from Citi's own announcement. That is the most consequential thing said about institutional Bitcoin this year. 4 words that most people read straight past without understanding what they actually mean. Don't leave. Let's talk about what Citi actually is. Not in the retail sense, not the credit cards and the checking accounts, but in the institutional sense, because the scale of what we're discussing here is something the human brain genuinely struggles to process. Citi is the custodian of $2.57 trillion in assets. It has operating relationships with more sovereign governments, central banks, and pension funds than almost any other financial institution on Earth. It is one of the primary settlement agents for the global FX market, a market that turns over approximately $7.5 trillion every single day. Its Treasury and Trade Solutions division manages over $5 trillion in annual payment flows across 90-plus currencies. Its global network spans 95 countries. Its institutional client base doesn't think in thousands or millions. It thinks in billions and trillions. Now ask yourself, what happens to Bitcoin's structural demand when an institution of that scale opens a custody account, and their clients can hold Bitcoin in the same account as their US treasuries? That is the institution that publicly announced at the World Strategy 2026 Forum in late February that it is launching institutional Bitcoin custody. Not as an experiment, not as a pilot, as a fully integrated product. Nisha Surendran, Citi's head of digital asset custody development, said it directly. We will be offering our clients a single service model across crypto, securities, and money. Read that again. Crypto, securities, and money. One service model. 3 words that the entire financial industry has kept in separate boxes for the last 2 decades. Crypto, securities, money, collapsed into a single unified service structure. That's not a product announcement. That is a declaration that Bitcoin's era of institutional quarantine is over. Bitcoin positions, she confirmed, will flow into the same reporting channels and tax workflows as equities and bonds. Clients will be able to instruct transactions via SWIFT, the global interbank messaging system that moves money between central banks and sovereigns. Bitcoin will sit inside the same master safekeeping account as US treasuries, foreign bonds, and tokenized money market funds. Now, here's the detail I told you about, the one most people read past. She specifically referenced cross-margining, the ability to use crypto assets as collateral at traditional exchanges or broker-dealers, and vice versa. Bitcoin is margin collateral against a traditional equity or fixed income position. Think about what that actually means. You're a pension fund. You hold $2 billion in US treasuries. You also hold $100 million in Bitcoin through your Citi custody account. Under a cross-margining framework, your Bitcoin isn't just sitting there as a separate speculative line item. It's functioning as live, active collateral, eligible to back derivatives, positions, margin requirements, structured products. That is not Bitcoin as a trade. That is Bitcoin as a balance sheet instrument, as fundamental to the institution's financial plumbing as a government bond. Stay with me, because the infrastructure sitting underneath all of this is something called CIDAPI, the Citi Integrated Digital Assets Platform. It powers the issuance, transfer, custody, and programmability of tokenized assets across both public and private blockchains, built at an enterprise level. One build, universal deployment across every use case. Custody, settlement, cross-border payments, stablecoins, tokenized funds. And it's already live. Citi Token Services for Cash is a 24/7 blockchain-based network moving money continuously between New York, London, and Hong Kong, around the clock, without the constraints of traditional banking windows. CEO Jane Fraser called it the next evolution in the broader digitization of payments, financing, and liquidity. Now, I want to ask you a question that I think reveals exactly how most people are misreading this market. If Citi has been building a 24/7 blockchain-based payment network for over a year, and it's already live, already processing real money, why is retail still debating whether banks will ever accept crypto? The banks didn't wait for the debate to end. They built while the debate was still happening. Cross-border payment flows are projected to reach $250 trillion by 2027. Not billion, trillion. Citi is a primary player in that market, and they are building a blockchain layer, stablecoins, tokenized deposits, Bitcoin custody, digital asset accounts, directly underneath those flows. Citi doesn't need retail. It has governments, it has pension funds, it has multinational corporations with 8-figure monthly cash requirements. When those clients start allocating even a fraction of their treasury reserves into Bitcoin through a Citi custody account, The structural demand shift is not measured in individual trades. It's measured in baseline institutional flows that don't stop when retail panic sells. Think about that for a second. Really think about it. And now, we need to understand why the regulatory environment is making all of this not just possible, but inevitable. Because the policy backdrop right now is doing something nobody in crypto expected 5 years ago. Something that most retail investors are reading completely backwards. Here is the question. I want you to sit with what has historically been the single biggest barrier keeping institutional capital out of crypto. Not a rhetorical question. I want you to actually think about it for a second before I give you my answer. Because most people get this wrong. And getting it wrong means misunderstanding where we actually are in the adoption cycle. It wasn't volatility. Institutions manage volatile assets every day. Equities are volatile. Commodities are volatile. Emerging market currencies are volatile. A 30% drawdown in an emerging market bond portfolio does not make a pension fund stop holding emerging market bonds. It makes them reassess sizing, not existence. It wasn't skepticism. Institutions are paid to evaluate and price skepticism. The single biggest barrier was regulatory ambiguity. Specifically, how do regulators treat crypto assets on a bank's balance sheet? What's the capital charge? What are the reporting requirements? What happens to a bank's Tier 1 capital ratio if it holds Bitcoin? These questions matter more than price at the institutional level. A pension fund does not move until it has clear guidance from its regulatory body. A custodian bank does not hold client assets without knowing exactly what risk-weighting framework applies. The absence of a framework isn't neutral. It's a hard stop. Now here's what I need you to stay with me on, because this is the moment where I think most retail investors misread the regulatory story. The Bank for International Settlements, the BIS, the central bank of central banks, the institution that sets the frameworks every major bank in the world operates under, spent years working on exactly this question under the Basel III framework. And in 2022, they released their final crypto asset standard. The key outcome? Banks are permitted to hold limited amounts of Bitcoin and other Group 2 crypto assets, but with a 1,250% risk weight, meaning full capital deduction. Retail read that headline as, "Banks are being crushed under regulation. Bitcoin loses." Institutions read the same document and thought something completely different. They thought, a framework exists. We now know the rules. We can build. It's conservative. It's restrictive. But, and this is the part that almost nobody emphasizes, it exists. For the first time in history, there's an internationally recognized regulatory framework that tells a bank, here's how you hold Bitcoin. Here's the capital treatment. Here's the compliance structure. That is not a constraint. That is an invitation. And can I ask you something? When the Basel Committee, a body that represents central banks and financial regulators from 28 jurisdictions, takes the time to draft a formal capital treatment for a specific asset class, does that sound like a regulatory body that thinks the asset class is going away? Or does it sound like a regulatory body that is preparing the infrastructure for it to stay? Meanwhile, in the United States, Washington has been moving quickly. The Genius Act, which creates a federal framework for stablecoins, gave major financial institutions the regulatory confidence they needed to begin building dollar-denominated digital products at scale. The SEC has cleared the path for spot Bitcoin ETFs, and the current administration's general posture toward digital assets has been the most favorable in the asset class's entire history. 9 global banks, Goldman, Citi, BofA, Deutsche Bank, UBS, BNP Paribas, MUFG, TD Bank, and Santander, felt confident enough in this regulatory environment to announce a joint G7 stablecoin consortium. When 9 global, systemically important banks make a collective bet in the same direction, that is not speculation. That is a coordinated infrastructure decision. And this is the twist I need you to absorb completely. Regulation isn't killing crypto. It's standardizing it. And standardization is exactly what institutional capital requires. The moment a framework exists, the moment a risk committee can open a policy document, read the applicable rules, and sign off on an allocation, the asset class transforms. It stops being a frontier and starts becoming a product. That transformation is happening right now, in real time, in this market. While prices drift sideways and retail despairs, stay with me through the next section, because this is where it all clicks together. Everything we've covered, custody, scale, regulation, it all converges into a single market structure shift that is quietly happening in the background of every Bitcoin price chart you've been watching. And once you see how all of these pieces connect, you'll understand why the most important Bitcoin buyers of 2026 may never show up on a Coinbase order book. Let me show you something most retail investors never think about. When a $50 billion European pension fund decides to allocate 1% to Bitcoin, that S a 500 million position, what actually has to happen? Map it in your head. because institutional adoption doesn't show up as a giant green candle. It shows up as infrastructure. There are 4 prerequisites. 1, qualified custody, a regulated insured bank that can hold Bitcoin on behalf of institutions. That's where Citigroup comes in with its custody platform. 2, integrated reporting institutions need to see Bitcoin next to equities, bonds, treasuries, same compliance framework, same reporting standards. 3, institutional scale liquidity. A $500 million trade doesn't go through a retail exchange. It moves through OTC desks, prime brokers, and structured market makers like Jane Street, who can execute 9-figure blocks without moving the market. 4, collateral eligibility, the most important one. When Bitcoin can be used in repo agreements, margin frameworks, derivatives clearing, when it becomes cross-marginable, it stops being a speculative silo. It becomes treasury infrastructure. Now, here's the real question. How many of those 4 existed inside a major traditional bank 12 months ago? Maybe 1? Maybe 2? Now, with Citi's custody rollout, all 4. That's not retail adoption. That's institutional plumbing. And when the prerequisite stack completes, allocations don't trickle. They flow. Citi owns securities services. Survey projects, roughly 10% of global market turnover will be digital within 5 years, in markets that move tens of trillions annually. Think about what that means if even a fraction of that flows through Bitcoin rails. ETF creation gets smoother, prime brokerage lending deepens, CME derivatives expand, and remember, Bitcoin futures already trade on the Chicago Mercantile Exchange. Replay this sentence. Bitcoin is no longer just a traded asset, it's becoming embedded financial plumbing. And once an asset becomes plumbing, removing it becomes almost impossible. That's the moat being dug right now. But this leads to a deeper question. If Bitcoin is now collateral, if it's balance sheet, if it's treasury integrated, what does that make it? Why this changes Bitcoin's identity? Think back to 2017. Bitcoin was the rebel asset, anti-bank, anti-establishment. Be your own bank. That identity was real. Its fixed supply is still real. Its decentralization hasn't changed. But here's the uncomfortable question. Was the rebel identity the destination? Or was it the vehicle? Because today, Bitcoin's functional role is shifting. Old identity, speculative, counterculture, outside the system, new identity, collateral layer, treasury hedge, settlement, neutral reserve asset. The US government holds Bitcoin reserves. Strategy, formerly MicroStrategy, keeps accumulating. BlackRock's ETF now holds hundreds of thousands of BTC. Sovereign funds like Mubadala Investment Company have added exposure. And now Citi is building custody infrastructure for sovereign wealth funds, pensions, and central banks. So ask yourself, at what point does an asset held by governments, sovereign wealth funds, the largest asset manager in the world, and a global bank custody platform, stop being a rebel asset and start being a reserve asset? I think we just crossed that line. Bitcoin didn't defeat the banks. The banks adapted to Bitcoin. And that shift from ideology to infrastructure may be the most important evolution in its history. Let me bring you back to the question from the beginning. Is Wall Street buying Bitcoin or rebuilding it? Pause for a second and answer it in your own head. Here's mine. They're not just buying it. Buying is a trade. They're not rebuilding it either. The protocol hasn't changed since January 3rd, 2009. They're integrating it. And integration is more powerful than speculation, because integration means allocation models change, custody frameworks expand, compliance barriers disappear, structural demand builds. Not the emotional demand that swings with price. Structural demand, slow, massive, persistent. Meanwhile, the digital ecosystem expands. Stablecoins, tokenized cash, blockchain settlement layers, all being built by the same institutions retail once thought were Bitcoin's enemies. Bitcoin is no longer operating outside the system. It's operating inside it. Here's the final thought. The bear market is real. Volatility is real. Macro uncertainty is real. But infrastructure doesn't get built in bull markets. It gets built in silence. Citi didn't build custody for a pump. They built it for permanence. So here's the question I want you to answer in the comments. If institutional custody accelerates allocation, the way ETFs accelerated retail demand, what does Bitcoin's structural demand look like 18 months from now? And more importantly, where do you want to be positioned before that answer becomes obvious? If this breakdown gave you a new lens on Bitcoin, not as a trade, but as infrastructure, share it with someone who still thinks this is just about price. Subscribe to the Wealth Continuum if you're here for institutional signals, not retail noise. Because the biggest move of 2026 might not be a breakout. It might be a balance sheet decision. The infrastructure is being built. The only question is whether you're paying attention.